what to expect in 2022, the year of central banks seeking normalization. That's what I've defined the title of potentially 2022. Okay, bit of content here, but let's go through it. Let's go through it together. Okay, so at the end of 2021, major central banks, including the US Federal Reserve, Bank of England, and the European Central Bank, all attempted to navigate a new environment of higher inflation. So the focus moved away from recovery from a pandemic, new variants coming out in regards to sort of the COVID. The focus has been, how do we tame these higher inflation numbers being reported? Okay, that's the key there. So with deviation between them, okay, so we have seen deviation between them on when to increase interest rates. So for example, Bank of England had surprisingly raised interest rates for the first time, and being one of the leading central bankers of a developed country to do so at the end of 2021. We now have potential 4 rate hikes forecasted for the Federal Reserve. From before the holiday break, towards the end of 2021 into the month of December, the guidance was 3 rate hikes. So we're seeing the rhetoric change on an ongoing basis, especially coming into the new year. The ECB have shown more dovishness, but they are starting to move away from the dovishness, almost similar to how I explained Bank of England expected, not Bank of England, Bank of Japan expected to be less dovish than previously. We may see ECB follow the same suit as well. So we're seeing that central bankers are facing these complex macroeconomic backdrops. Yeah? And what central banks are looking for is that Goldilocks policy, right? So what is the Goldilocks policy? It means that, you know, we don't want to be too hot and we don't want to be too cold. Right now, we're seeing that the economic activity is running a little bit hot, and therefore central banks are looking to raise rates a little bit quicker. But if it starts to be the opposite, where markets are looking a little bit colder, then they might say, okay, hang on, we may not raise rates in the upcoming quarter expected, we might raise thereafter, right? So they're trying to sort of find the middle ground between managing economic activity with the backdrop of this in high number of inflation, to ensure that there's normalization and growth expected in the equity markets and overall stock markets, in comparison to raising interest rates on an ongoing basis. Yeah. So, you know, the key elements that I want to sort of take away from this. So central banks and financial markets have both bearish and bullish factors to weigh up. That's what we need to be doing, is weighing up what are the key factors in regards to it being bearish and what are the factors around being bullish. So in regards to bearish developments, this includes a reduction of loose macroeconomic policy conditions. Okay, so that is bearish. That is bearish, right? So we're hoping that we don't see this. If that occurs, generally that's occurred due to a certain reason, right? And that could be sort of, you know, a new variant being released, and we may see more stimulus packages coming into place or further restrictions, and that could have lead the central bank to wanting to apply a more loose macroeconomic policy condition. High inflation, we already know, is a big concern. So high inflation is the biggest concern at this current moment. And of course, as I already mentioned, the uncertainty around the pandemic. Yeah. Okay, yet the healthy state of economic and corporate earnings growth is also key, right? So we're talking now about the bullish side of things. So we've seen the last 4 quarter earnings that have been released in 2021 all coming out better than the prior, right? It's actually been one of the best since multiple years in regards to earnings over the course of that year, over those quarters. And that's both from, you know, corporate earnings, but also from an economic standpoint, activity, you know, GDP is back up, unemployment levels are much lower than you know, on a quarter-on-quarter basis. So we're seeing huge improvement from an economic standpoint as well as a corporate standpoint. Even the private sector balance sheets, these are your households. Because of these stimulus packages that have gone out to these individuals, they've actually not done so badly as previously assumed, right? And an accelerated effort by businesses to advance the climate transition as well. So these all point to a more bullish scenario. So you need to factor all these key scenarios, maybe look into them a little bit further to really understand them individually. And these are the factors that I'd be concerned about going into this year. So what we have here is, let me just move this tab out the way. Just going on. Okay, there we go. This is the US monthly inflation year-on-year percentage change versus the Fed funds interest rates since 1970. Okay, so it's a big picture view here. So this green line is just showing us where inflation is at this current moment. And you could see how since sort of the pandemic in 2020, the inflation level has risen substantially. Okay, it's back out to, you know, it's almost 40-year sort of levels. Okay, in addition to that, I mean, this taking it around the 5%. We're sort of somewhere in this region here. Just to sort of, you know, this is not that much up to date, but okay, we're sort of in this region over here, and we're going back to sort of 1980 sort of levels in this region here. Okay. Whereas interest rates has remained at these record lows, as you can sort of imagine. Okay, so we've been at these lows, almost 2010 lows, 2009, 2010 lows, when you had the 2008 global financial crisis. Okay. Ooh, let me just make sure. Yeah. So this is your purchasing power of $100. Okay. With high amount of inflation, what it does is goods and services are going up in prices. Okay, so it goes up in price on a year-on-year basis or quarter-on-quarter basis. So we're having goods and services going up in price, but at the same time, earning rates and earning growth has not stayed in line with this. Your local sort of interest, your savings account does not provide a higher interest rate in comparison to the inflation rate even. So what we're seeing is that any dollars that you hold in a bank is actually losing value in regards to what it could purchase over the period of time. Yeah. So as you can see, sort of the purchasing power of $100 has fallen, and this is taken from 2000. Okay, and where was that? So let's assume $100. It's around $60.6. So looking at the effects of higher interest rates, okay, so, you know, what will these higher interest rates do? Why are central banks using interest rates as the tool as to tame the inflation scenario that we see? Okay, so what it does is, firstly, it increases the cost of borrowing. Okay, so increased the cost of borrowing. Okay. The slightly sort of negative impact of that, it reduces investments. Okay, so there are a limited amount of investments being made, but that will also that will lead to a lower economic growth. So that's the sort of the downside of the increased cost of borrowing. There's less because the cost of borrowing is raised, therefore there's less people making the same types of investments, and that leads to lower economic growth. Higher mortgage interest rates and interest payments. Okay, so if you're on for example, in the UK, you've got two options of a fixed rate and a variable rate. If you're on a variable rate, as interest rates rise, you're paying more on a month-on-month basis or quarter-to-quarter basis based on the new rate, the new bank rate. That reduces consumption, right? So if you're now paying and contributing more towards your mortgage, you have less to spend in, you know, other areas, other sort of things that you like, other things that you consume, right? That also reduces money in the market, therefore sort of lower economic growth taking place there. Yep. Increased return to savings. As the other side to it is, if you're holding capital and you're saving that capital, saving money in a savings account, the savings rates will also increase. Okay, so you actually make a larger return on your savings. So you would keep more money in the bank, right? You would want to park more money in your bank account because you're earning a higher interest rate, right? That could also have an impact also on the reduced consumption side of things. So you're buying less goods and services, which has a lower economic growth impact. It can also have an impact where, yeah, you might see sort of, well, this is more with the higher mortgage interest payments, right? So if the payments are higher, then you'll start to see fall in house prices as well, right? And falls in house prices actually leads to lower inflation. Hot money flows, right? This is the appreciation in the exchange rate leads to lower inflation levels. So these are sort of the effects of high interest rates on both the economic growth, but also inflation. Effects of increase in interest rates from a personal and an economic standpoint. So I can break that down as well. So from a personal standpoint, increased cost of borrowing, improved return for savers, higher mortgage interest payments if you're on a variable rate, increased cost of bank loans. Banks may be more willing to lend and could reduce confidence of borrowers. From an economic standpoint, the currency will appreciate, right? So that makes exports less competitive, imports cheaper. Inflation will tend to be lower. Economic growth will tend to be slower, and unemployment could rise. Government will see rising borrow costs. So this kind of indicates, right, how important, if we start to see a slowdown in economic activity, economic growth, that's why the Federal Reserve wants unemployment levels at super lows, right? Because we might see a slight jump in unemployment levels. Okay, so yeah, all of these have a knock-on impact in regards to that tool being used, raising interest rates. Something that I have sourced is that the assumption has been that higher rates is going to be bearish for the markets, right? That's not always the case. In fact, here's the data to prove it. Okay, it's about the steps that they take to raise rates, right? The more aggressive, the more hawkish they are, the more hindrance that will have in the equity markets and in the stock markets. Okay, but if they are sort of playing within the Goldilocks zone of it's not too hot, it's not too cold, staying in the middle there, right? And they're able to maintain normalization all the way through, then actually it could be very bullish for the stock market. Okay, so this is the S&P 500 index returns under a higher 10-year yield. Okay, gains of more than 100 basis points. So looking at sort of specific dates, right? So rising rate start date, and that's the end date. Okay, let's just take the most recent. Okay, so we're looking at September 2020 up till March 2021. That's close enough to duration of 12.9 months. Oh, sorry, well, yeah, that's right. So what we're seeing here is the change in the 10-year Treasury yield is 1.2%. The S&P 500 gained 44% in that sort of period. Okay, looking at 2016 up till 2018, 27 months there. Change in 10-year Treasury yield was an increase of 1.9%. Again, a 35% gain. So just looking at sort of overall, you can see there's more gains than there are losses. And if you take the average, right, average has been 17.3%, the median is 15%, and the actual positive in percentage is 78.6%. So yes, higher rates is bullish for equity markets.